you need to close your trading terminal for a moment. Stop looking at the flashing red and green lights of the semiconductor, stocks, and the AI hype train. If you are serious about finding value, deep, asymmetric value, you have to look where the market stopped looking 3 years ago. You have to look at the plumbing of the global financial system. Today, we are not talking about a flashy new IPO. We are analyzing a company that survived a near-death experience in 2020 and has quietly transformed itself into a cash flow monster. While Wall Street was distracted, we are talking about Euronet Worldwide. Most investors look at the chart of Euronet and see a boring payments company. They see ATMs in Europe. They see money transfers. They think old world. And frankly, if you only looked at their 2020 financial statements, you would be right to be terrified. But I have spent the last week deconstructing their 10Ks from 2020 through 2024, and crucially, the 10Qs from the first 3 quarters of 2025. What I found is not a dying legacy business. It is a coiled spring. We are witnessing a textbook turnaround story that is pivoting into a high-margin digital growth phase. Let's go back to the scene of the crime. The year is 2020. Open the 2020 10K. It is a bloodbath. Euronet's most profitable segment, the EEFT segment, which operates thousands of ATMs across Europe and Asia, was effectively shut down overnight. Borders closed. Tourism vanished. Revenue in that segment collapsed. The company's stock price was cut in half. The market priced this company as if travel would never return. They took on debt just to survive. The narrative was broken. But here is where the lazy analysis ends and the real work begins. While the world was locked down, Euronet didn't just hibernate. They restructured. They aggressively invested in their digital payments platform, REN. They modernized their money transfer business, RIA and Z, moving users from physical storefronts to mobile apps. Now, let's fast forward to the 2024 10K. The contrast is staggering. Revenue didn't just recover, it broke new records. But the market is still pricing this stock like it's a cyclical travel play. They are missing the structural shift in margins. Look at the data from the September 30, 2025 10Q. This is the smoking gun. In the third quarter of 2025, consolidated revenue continued its double-digit trajectory. But look deeper. Look at the EFT segment again. Not only has volume returned to pre-pandemic levels, but the revenue per transaction has increased due to value-added services like dynamic currency conversion. The travel recovery trade is over? No, it has matured into a steady cash cow. The operating income from this segment alone is now funding the rapid expansion of their digital fintech capabilities. Let's talk about the money transfer segment. In the 2021 and 2022 10Ks, we saw a struggle to maintain margins as inflation hit. But in 2025, we see the fruits of their digital labor. Direct-to-consumer digital transactions are growing at a rate that far outpaces the physical retail business. Why does this matter? Because a digital transaction has significantly higher incremental margins than one that requires a physical agent and a brick-and-mortar location. We are seeing a mix shift. As the digital portion of the pie gets bigger, the overall profitability of the company expands structurally. The market is ignoring this margin expansion story. Now I want to draw your attention to the balance sheet. In 2020, cash was burned to keep the lights on. In the 2025 filings, we see a fortress. The company has successfully deleveraged. They have paid down the emergency debt taken during the crisis. The cash flow from operations in the first 9 months of 2025 is robust. What do they do with this cash? They are buying back shares aggressively. When a management team buys back stock while the price is languishing, they are screaming at you that they believe the company is undervalued. We are seeing a reduction in share count that will boost EPS, even if net income stays flat, which it won't. But the real growth explosive lies in the ePay segment and the REN ecosystem. This is the part of the business that connects brands like Apple, Google, and Sony to retailers. It's the back-end infrastructure for digital gift cards and mobile top-ups. In the 2023 and 2024 reports, we saw steady, boring growth here. But in 2025, we are seeing signs of acceleration as they integrate more digital wallets and alternative payment methods. This is pure tech infrastructure. It deserves a tech multiple, yet it is trading at a utility multiple. Let's look at the operating margins again. In 2020, operating margins collapsed. By 2024, they had normalized. But in the Q2 and Q3 2025 reports, despite inflationary pressures on wages and SG&A, we see resilience. This comes from operating leverage. As revenue grows, the fixed costs of their massive payment network remain relatively stable. Every additional dollar of revenue flows more efficiently to the bottom line. This is the magic of a scalable network business once it passes the break-even point of fixed costs. The bear case is simple. Cash is dead and digital wallets will kill ATMs. I have read this in every analyst report for 5 years. But look at the numbers. The number of active ATMs in their network has actually increased in key high-traffic tourist locations in 2025 compared to 2019. Cash is not dying in the cross-border travel market, it is thriving. And even if it declines eventually, Euronet has hedged this with their REN payments platform, which processes purely digital transactions for banks and fintechs. They are playing both sides of the coin. They win if cash survives, and they win if payments go digital. Valuation is the final piece of this puzzle. If you look at peers like Wise or Adyen, they trade at 30, 40, sometimes 50 times earnings. Euronet trades at a fraction of that. Why? Because the market still views them as an ATM company. This identity crisis is your opportunity. As the revenue mix shifts toward digital money transfer and the e-pay software segment, the market will be forced to re-rate this stock. We are buying $1 of earnings for 60 cents. Because the market hates the packaging? To summarize what we found in these 5 years of documents, we saw a company face an existential crisis in 2020. We saw them survive in 2021. We saw them stabilize in 2022. We saw them return to growth in 2023 and 2024. And now, in late 2025, we are seeing them accelerate. The balance sheet is clean. The margins are expanding. The digital pivot is working. And the stock price hasn't caught up. This is the definition of asymmetric risk-reward. You have the safety of a profitable, established business with the upside of a fintech growth story. Stop chasing the hype. Start looking at the numbers. The numbers tell us that Euronet Worldwide is waking up.